Microsoft Corporation recently released their latest quarter's earnings and the stock took a big jump up. If we now look in the last 5 days, they're up over 9%, trading at $425.40 per share. Now, if you're not familiar with my personal portfolio, Microsoft has actually been one of the largest positions in my portfolio for a pretty long time now. If we blow up my growth chart, we can see this is currently a position I'm up over 61% on. Now, let's go ahead and dive into that earnings report because there's some pretty interesting takeaways you have to understand if you're interested or an owner of Microsoft stock. Now, to start off, Q3 GAAP earnings per share came in at $3.46, which was a beat by about 24 cents, and revenue came in at $70.06 billion, up over 13% year over year, and was a beat by $1.62 billion. So yes, they did beat on top and bottom lines, but I think it's always important to put these numbers into perspective. Let's go ahead and jump over to my quarterly data tab. We have Microsoft plugged in, but I don't want to look at revenue. Let's go ahead and look at earnings per share. We can see all this data will automatically load in, and like always, if you'd like to download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, when it comes to Microsoft's earnings, here we go, right here. This was their Q3, fiscal Q3 for 2025. It came in at $3.47. So this was a record-breaking quarter of earnings for the company. And if we compare this to Q3 of 2024, that came in at about $2.95. So we're talking about a considerable jump up in earnings. If we do the exact same thing, but for revenue this time, again, we can see this was a record quarter for revenue, coming in at about $70.06 billion like we just saw. And if we compare this to Q3 of 2024, that was about $61.8 billion, so a $9 billion jump nearly. Now, this track record of growth is obviously nothing new for Microsoft. If we jump over to the stock screener and look at MSFT, what we can see is in the last decade, revenue per share has gone from $10.46 all the way up to about $33 at the end of 2024. If we look at earnings in 2014, $2.66, in 2024, $11.86. So Microsoft has obviously grown revenue and earnings at a pretty high rate over the past decade. And perhaps one of the key signs of a quality company is going to be return on invested capital. How profitable are the projects the company is reinvesting their capital back into? And we can now see for 4 consecutive years, return on invested capital has been above 20%. Typically, as a baseline, you probably want to see at least 10% for most companies. 15% is pretty impressive, and 20% is a high quality company. If we look at the profitability sheet, let's plug in Microsoft. One of the things we have to point out is the gross profit ratio is very high. We can see the 10-year average gross profit ratio is 67%, and last year's came in at almost 70%. So the profitability of the company is growing. So when you talk about the fact revenue is growing at a high rate and the gross profit ratio is climbing, that is a stellar combination for massive earnings growth, and that's exactly what we've been seeing. So let's go ahead and jump into these earnings slides just a little bit closer, start to break this down. Now, before we go any further, I do want to quickly mention Seeking Alpha just started running their spring sale where they're giving a limited time offer. You can get a 7-day free trial, you can get a discount on the price, as well as getting their next alpha pick for free. Seeking Alpha is an investment research platform I've been using for very many years now, and if you've watched my videos, then you already know that because I use it in nearly all of my videos. But along with these phenomenal features, you can also get access to premium articles from analysts actually like myself. You can see here, I recently wrote an article on UNH stock. So if you've been waiting for an opportunity to get access to Seeking Alpha, now could be a good time to start a free trial and see if it's for you. Link in the description for the discount. Now we can see there's 3 main business segments for Microsoft. We have productivity and business processes, up about 10%, intelligent cloud, up about 21%, and more personal computing, up about 6% overall. Now let's talk about capital allocation here for a moment. What we can see is cash return to shareholders. $9.7 billion returned to shareholders, with $6.2 billion of that being dividends and also $3.5 billion in share repurchases. So let's get a dividend perspective of the stock for just a moment and look at Microsoft. What we can see is Microsoft is a low yielding stock. It's about 0.74%. If you look at it on a forward-looking basis, maybe just a little bit higher, but here's what's impressive. The 10-year dividend CAGR is about 9 to 10%. So we can see, yes, certainly a history of growing those dividends at a high rate, but that doesn't even paint the whole picture. This company could be growing their dividend at a much higher rate if they choose to do so. How do we know this? Well, it's because free cash flow has been growing much faster than the dividend, and as a result, the free cash flow payout ratio has actually been going down over the past decade. This is exactly what we want to see out of our dividend growth stocks. That is, assuming they're growing their dividend at a healthy rate, which Microsoft is certainly doing. So there's still immense dividend growth potential for this stock in the future. Now, obviously, dividend growth is a byproduct of growing free cash flow. I kind of alluded to that just then, but here's what we can see. Free cash flow was $20.3 billion, which was actually down 3% year over year, but they explain why this is. This is reflecting higher capital expenditures to support our cloud and AI offerings. So yes, I completely expect free cash flow for Microsoft to be a little bit lower in 2025, but this is all a part of the plan. They're ramping up capital expenditures to support future growth of the business. And this is why it's so important to dig into the details to make sure you really understand what's going on with the business. Now, near the end of the earnings report is perhaps one of my favorite slides, and this is something I always have to touch on when I talk about Microsoft, because it's actually one of the reasons that I've chosen to hold on to this stock for such a long time and continue to believe in this stock. Look at all the different products within Microsoft's ecosystem. Microsoft is essentially its very own tech ETF. They have commercial bookings, the Microsoft 365 products, they have LinkedIn, they have Xbox, they have Azure, they have search and news advertising revenue as well. This by all means is its own tech ETF. And with that being said, yes, it's diversified revenue streams, but pretty much all these revenue streams are growing at a very high or at least very healthy rate. Commercial bookings, 18%. Microsoft Cloud revenue, up 20%. We can see these other 365 revenue services are getting typically double-digit growth. We can see LinkedIn revenue still growing, up 7%. We can see Azure and other cloud services revenue, a key highlight, up 33%. This is one of the most well-diversified tech stocks out there, and it's why I'm so comfortable with it being such a large position in my portfolio. Now, the management team did allude to the future outlook of the company. What they said is the company projects Q4 revenue for productivity and business processes between this range here, about 32 to 32.35 billion, representing around 11 to 12% growth in constant currency. If we come down here, we can see Azure revenue. One of the key points for the company is forecasted to be between 34 to 35% growth in constant currency, with Windows revenue projected to decline to the low to mid single digits. So obviously I'm bullish on Microsoft, and it's paid off quite handsomely over the past few years, but I do want to show you the other side of the story so you get a better perspective. I want to scroll down and point out a key quote from the Microsoft CEO. He stated, "Cloud and AI are the essential inputs for every business to expand output, reduce costs, and accelerate growth." He also stated that Microsoft opened 10 new data centers around the world during the third quarter. Now, why is it important? What does this mean? Well, like I already mentioned, when it comes to free cash flow is expected to be a bit lower in 2025 due to higher capital expenditures to support their cloud and AI offerings. So they're making heavy upfront investments. Now, what this means is the future growth potential of the company is dependent on those investments. And historically speaking, like I've already pointed out, return on invested capital for this company has been very high, meaning those investments have been paying off. But with that being said, if return on invested capital for these upfront investments is quite a bit lower than they projected, that could prove to be pretty detrimental to the future earnings growth of the business. So something to keep in mind and something to watch closely. But the question we have to ask ourselves now is Microsoft an interesting stock, now back up to $425.40 per share? I bought a lot of Microsoft stock back in 2022 when the stock was trading in the low 200s. And then when the stock dipped back below $400 recently, that was the first time I had added shares of Microsoft to my portfolio in quite some time. So what does the valuation look like now at $425? Well, to answer, let's go ahead and jump over to my stock valuation sheet and come up here and plug in MSFT. Now, the first valuation we'll go ahead and look at is going to be our discounted cash flow analysis. What we're doing is we're valuing the company based on the future free cash flows we expect them to produce. And assuming a free cash flow growth rate of about 15% and also accounting for things like cash and cash equivalents and the total debt of the company, we come to a DCF price per share of close to $350. If we look at the historical multiples valuation, what we're doing is we're looking at how the market has historically valued Microsoft based on their PE ratio. And what we can see over the last decade is the average PE ratio for Microsoft was about 31.1. Well, for the trailing 12 months, it's sitting at 32.7, so it's only about 5% off from that average historical ratio. So technically speaking, based off this formula, it is slightly overvalued, but it's pretty much trading right at its historical ratio. If we look at Microsoft through a comparables multiples valuation, we can take stocks like Apple, Meta, and Amazon, who are certainly not perfect comparables, but they are in the big tech category. We can see the average PE ratio of these stocks is about 29.12, which if we apply that to Microsoft, the fair value would be about $378.31. Finally, if we look at that dividend discount model, assuming Microsoft grows their dividend at 8.25%, which has certainly been no problem for the stock over the past 5 and 10 years. In fact, it's even more sustainable moving forward with that lower free cash flow payout ratio. what we can see is the stock would be worth about $456.09, or about 7% higher than that current share price. So if we average those valuations we just looked at together, the multiples, DCF, and dividend discount model, we come to an intrinsic value of about $394 a share, which it looks like is about 8% lower than the current share price. So with a 10% margin of safety, that would put your acceptable buy price at about $354.59. Now, I want to be completely clear. It is very, very rare that Microsoft stock is not going to trade at a premium. Why is this? Well, simply because it's one of the highest quality stocks in the world. Investors are willing to pay for quality. They're willing to pay for predictability. And the future free cash flows for Microsoft are really quite predictable. If you would have spent the past decade waiting for the perfect opportunity to buy Microsoft, you would have found very few opportunities. I mean, look at this historical multiple valuation. Yes, there were some chances in 2016 and 2017 when that multiple got pretty low, but for the majority of the past decade, the average PE ratio was 31.1, which most people would consider quite expensive. But despite this, if you look at the historical returns for Microsoft over the past decade, they've way outperformed the market, up over 727%. So no, that doesn't mean you should ignore valuation, but you do have to understand, you typically have to pay a premium for very high quality companies, and Microsoft is no exception. So again, I was able to add a few shares to my portfolio for the first time in years when it did dip below that $400 range, but it has quickly jumped back up, really not to my surprise. But go ahead and let me know what you think of Microsoft stock in the comments down below if you plan on buying or selling. And like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.